Good morning, everybody, and welcome to MarketCast 13. Let's hope it's not unlucky for any of us. And we're back in Bournemouth. You'll recall for MarketCast 12, we recorded that up in Rosebery Avenue up in London, the Oliver office in London, and we're joined by Richard Donnell, Zoopla's Richard Donnell, who was a great guest on MarketCast 12 for us last time out. But now it's back to me flying solo, so we are going to condense things down into 30 minutes. And I'm going to try and take you through where we are right now in the market and where the market's going next. As I always do at the beginning of these things, this is all about turning the art of the possible into the art of the probable, using as much data, as much good, solid information as we can to inform our view on where the market's going to move. In the end, it's a view, it's an opinion, much like everybody else's. So we'll come back to a little more of that later. In the meantime, the press seem to have eased a little bit in their attitude about where the market's going to go next. Even the Guardian says that we are nearing the end of these massive house price rises, but that the market's very strong. They say the market's very strong up in the top end of the market, up in London too. Bloomberg have come in saying that the housing crash might be avoided. So the word crash is still there in the headlines, but I think generally now the press have calmed down, and even those most siren voices are now moving away from the position of the crash. I think the Nationwide said on their last numbers that they put out that the current move from the peak of their index back in August to where it sits now is about -4%. So going back to that classic phrase that so many commentators have used, peak to trough, according to the Nationwide, we're currently sitting at about 4%. Definitely not crash territory. This has been in the news a big time. This is Skipton's track record mortgage, and this has picked up a lot of column centimetres. This story here I've nicked from Money Saving Experts website, and where they talk about, they sort of give it a cautious welcome. And obviously those of us that remember back to the days of 100% mortgages and 105 and even 110% mortgages and the problems that they created and precipitated the big crash, we all look upon this with concern. But the Skipton have actually introduced a set of criteria that I believe make this product A, fit for purpose, and B, something that's not going to cause massive problems for the buyers that actually use it. You can use it up to 600k, but crucially, you've got to have a good credit history. You've got to prove that you've paid rent for at least 12 months in the previous 18, and that you paid all the household bills, so the telephone, energy bills, and so on. And interestingly as well, they've said no new flats. So this is another product that's trying to fill the vacuum that got created by the end of Help to Buy at the back end of last year. And we've seen Deposit Unlock as well. And we've seen one or two developers come up with their own schemes as well to try and help first-time buyers either with a very small deposit or rent commitments that stop them saving deposits, offer a chance to get onto the housing ladder, particularly where the heat is so intense in the rental market. So it'll be fascinating to see how this outturns the track record mortgage from the Skipton. Picked up an awful lot of press coverage. But what I really want to start on today is the latest GfK survey, which came out at the back end of last week. And well, those of you who've watched this MarketCast more than once or twice will be familiar with this chart now. But for those that haven't, just really quickly, this is a survey of 2,000 people. GfK, in the old days, National Opinion Polls, NOP, have been carrying this survey out for over 40 years. It's incredibly consistent. They speak to 2,000 people across the UK and they ask them some very simple questions about how confident they are in the future on a range of subjects. And I've applied some of them to this chart here, where you get a majority of people answering in the positive. They think things are going to be better over the next 12 months. That moves it above this zero line, which as you can see is right at the top of this chart because everything's in negative at the moment. So that moves it above. Where you get somebody that answers in a negative way, things will be worse over the next 12 months. That moves it into negative, and then it creates us this super chart. Just 4 lines on this chart. The red line is the overall index line, and you can see in September, shortly after that infamous mini budget, where it hit all-time record lows on pretty much every count on the chart. And you can see that we have seen a steady improvement since that time. We are still in negative. Let's make no mistake about that. There is undoubtedly the pressures of inflation, of energy cost, of interest rates, and all the other things that contribute to that mean that we are still significantly in negative, but the improvement is unmistakable. And that's definitely feeding its way through. And I think as we get better news, it's a shame because the inflation numbers for April don't come out for another couple of days. I think they come out on the 24th, 25th of this month. And we'll see where that went. I have a sneaking suspicion that we will see quite a big fall in the CPI, the headline rate of inflation, and that will make a big difference. But look at the improvement, unmistakable improvement. Just take a look at how people think the UK economy is going to fare over the next 12 months. From, again, the mini budget low point right down here to where we are now. This is a jump up in excess of 30 points. That's a massive improvement. So still in negative, but great big improvement. The green line in here is whether people think the next 12 months will be a good time or a bad time to make a major purchase. And again, it's come from the low point in the autumn and is steadily climbing its way up. And finally, a really important measure is how people believe their own personal finances are going to fare over the next 12 months. That really does influence their buying decisions on a whole range of things. And again, here's our low point here, and here's our comeback. We are almost back to zero on that measure. Isn't that extraordinary? So you think about where we are with inflation and cost of living and so on, and bear in mind this survey goes right across all the socio-economic groups with age range from 16 right up to OAP, people like me. And you can see there, right across all social groups and all ages, that we are almost back to level there on that measure. Now that is a really important thing. It's very, very important for the property market. How people's confidence, how the level of people's confidence about what's coming next over the next year or two really does impact their buying decision. And for me, that's a massive factor when I set out my buying decision matrix. And you can see I've moved, for those of you that actually saw this last month, you can see that low consumer confidence is really moving back. It is still low. It is still low. It is still in negative. There's no question about that. But that's gone from being right up here. So in other words, a very high impact negative effect on the market. It has moved back and moved back. And you can see we've got high mortgage rates in here, but these have almost started to be baked in. When all the changes came about after the big collapse in 2008, 2009, and borrowers started having their mortgages stress tested up to 7%, it really did move us into a very different place. And so now as we come out of this extraordinary period of ultra low interest rates, back to what is probably going to be the more regular level of interest rate, buyers are starting to come to terms with that. It changes their choice, obviously, in terms of affordability, but that needs-based market is still there and is still operating. So you can see that even that has moved back slightly, as has affordability. High homeowner running costs is still there and it's still a big negative factor, but not quite to the extent that it was. And you can see general inflation now has moved back into a lower impact. And I think that will continue to lessen in terms of its impact as it reduces over the next 12 months. Into the positive effects, well, these are largely driven by the sellers. So in blue, discounts off asking price, financial products, the sort that we've discussed already. Part exchange, the builder's number one weapon in terms of its battle against the second-hand market. Low supply, high demand is still a thing, but I'll show you in a moment or two data that suggests that that is now starting to ease, so that is moving back in its effect. Stamp duty changes, the national insurance, the lack of a national insurance increase is still in there. And the employment market, although that is easing, is still relatively hot. So these are all the factors in the mix. These are all the things that are actually affecting the way I see the market moving over the next 12 months. Mortgage approvals, I confidently predicted that we would see this uptick come. So what we saw was the withdrawal of so many mortgage products, didn't we, in Q4 of last year. And here we are now that those mortgage products are back on the table and back available again. And those mortgage approvals are climbing and will continue to climb. So as you can see, the numbers here, as at the end of March, house purchase mortgage approvals back up to 52,000. So that's only around 8,000 short of where they would be in a normal market. And don't forget, when mortgages are around 65,000 a month, that generates about 100,000 transactions in a month. It's about 2/3 of the total number of transactions. These are coming back to normal levels, and that was what we confidently predicted would happen, and it is absolutely happening. And I believe that the next time that we look at this chart, this number will be back over 60,000 again. So all of this indicates us coming back to that classic 5-year market that we had from 2014 to 2019, and I am convinced that that's what we are going to see for the rest of this year. I love this chart. You'll know I've started including this chart in MarketCast now every month. This is the property mark chart. So this comes from their insight survey of their estate agent members. And it's a beautiful graphic indication of the deals that have been done over the last 12 months. The bit shaded in grey there are deals that were done at below asking price. The bit in orange there are deals that were done at asking price, and extraordinarily there in blue, the deals that were done above asking price. This is a really great snapshot of how the market is. That you can look at all the data you like, but once you start seeing this, up to 40% of deals being done above asking price, you don't need to be a genius to realise that the market is absolutely fizzing. And that's what it was doing last April. And here's this beautiful indication of how the market changed through last spring and into last summer, started to slow. I'm going to forget the mini budget hiatus, the last quarter of last year, which, as you know, I think is a bit of a sideshow, and look at the more the proper movement in the market, and you can see how that's gone, and you can see where it's settled. And here we are now. These are their latest numbers from last month, April numbers here, and we've still got deals being done, almost 5% of deals being done above asking price, which I find extraordinary, but it's true. And there you can see this growing bit of orange in here. So these are deals that are done at asking price, and this steady bit of grey there, people that are taking discounts from asking price, much more what we would expect to see in a typical property market. Again, another indicator that we are coming back to planet normal in terms of the market. These are the headlines from their April Insight report. 30% fall in prospective buyers, obviously really important, but that's comparing April 23 with April 22. Just think about the chart I just showed you, the April 22 chart that I just showed you there, with its monster levels of activity and screaming for every property that came onto the market. So no great surprise there. I think at the start of the year, I predicted about a 20% fall in volumes from last year into this year. And I'm still staying with that. I still think we'll be over 1 million transactions for the year. Availability of properties, 70% up. Again, this is compared with last April. Don't forget, last April was the peak of the of that real hot property market that we saw in 2022. And you can see there that we've got this 35% rise in the mismatch between supply and demand. So the market is balancing up, and this is a really clear part of it. No change in the number of rental homes available among their members. The rental market is really difficult for right now. It's absolutely red hot, and that is undoubtedly feeding more first-time buyers into the market as rental choice and availability of rental properties and rents themselves continue to soar. And I think that's a consequence of so many buy-to-let landlords deciding that they probably want to be coming out of the market right now. So that's a really difficult market, probably worth a MarketCast all on its own. But most importantly, I think, of the Property Mark charts in this month's survey, you can see that demand is starting to ease. This comes as absolutely no surprise to me, and this is precisely what we would expect to see coming into summer, and it absolutely fits with the forecast that I set out back last December. And we'll have another look at that forecast, updated now as it is with the latest numbers. But you can see here, this is demand starting to ease as we come down from this spring pulse that we had. So I think probably saying mini boom is going too far, but certainly a pulse in the market, which was a consequence of the artificial suppression of the market in Q4 of 2022. So since we last met then, I can't give you new inflation numbers. I say since we last met, this was the chart I actually showed you last month because I don't have a new one yet. It's a day away, it's 24 hours away. On this chart here, the CPI sits at 10.1%. It would not surprise me to see that number drop to 8 point something. I come down a full percentage point. I might be cruising for a fall there, but I believe that we will see a significant drop in inflation when the new numbers come out. And this is the reason why this great chart produced by Neil Hudson of Built Place, which shows here that in April of last year, in April 2022, that was where the massive climb in inflation came. We were 2 months in to the conflict in Ukraine and with all the consequences that had on energy prices and so on. And we saw this huge, here's Neil's trend line that he's put on the rate of inflation across the year. And there's that really steep climb in April. And of course, that comes out of the numbers. When we see the numbers that are published tomorrow, that comes out of the numbers. And that's why I think we're going to see quite a significant effect. I hope I'm not making myself look foolish there. I think it's going to start with an 8 inflation after tomorrow. For us, really importantly, then the mortgage rate trends. And these are great numbers produced by the Bank of England. And what they do is they look at all of the mortgages that are available out there right now. And then they produce the average numbers. And they base that both on 2-year fixed rate mortgages on varying loans to value. And then on a fixed loan to value of 75% on varying terms. And you can see, if you look at this, you can see where the trajectory of interest rates has been, despite the on May the 11th increase up to 4.5%, which we predicted would happen on last month's MarketCast. The next meeting, the MPC meeting, is on June the 22nd, I think. And I think that the argument for an increase there, another 25 basis points there, is not nearly so clear cut. I do think there will be one. I think that we'll probably see bank base rate go to 4.75 in June. A lot of data to go in before that happens. Obviously, the inflation numbers that are going to come out later this week will have a bearing on that. But even so, I still believe that the markets have priced these interest rate increases in already. And interestingly, when you look at these charts here, and you look at the 10-year money, which is the orange line there, and you look at the 5-year money, which is the mauve line there, and these are the lowest of the two. So these are the markets genuinely putting their money where their mouth is. So the cheapest money you can buy right now, or the cheapest mortgage you can get right now, is 5-year fixed. Now that, for me, says an awful lot about the way that the markets see interest rates are going to go. And I think this is going to be another new normal that we're going to see. I think that mortgage rates around the 5% mark, that is going to be another new normal. And that will have an effect on prices over time. It has to do. And of course, that's one of the things that it is designed to do. So here we go. You can see 5-year, 75% loan-to-value mortgages now at 4.17% average. You know, that's where the markets see that we're going to be heading. It's extraordinary to see how they view the way that interest rates are going to move. So despite all of that, well, the Rightmove popped up, the Rightmove index popped into everybody's inboxes on Monday, and you can imagine, look at this, a 1.8 increase in their index. And of course, this is an asking price index. These prices have not been achieved. And bear in mind that we have just looked at that property mark chart, haven't we? So all of the deals that comprise the grey part of that property mark chart are these asking prices, and those asking prices didn't get achieved. So provided we know what the Rightmove index represents, well, then of course we can account for it. But in my classic rule of consistent inconsistencies, for measuring trends, it's a really good indicator. And don't forget, the other really important thing to bear in mind about the Rightmove index is it represents 95% of all properties for sale in the UK. It's a huge and accurate guide to the way that sentiment is going out there, because although they are asking prices, and those prices we know will not be achieved, it suggests this is how people feel about how the market is right now. So that in itself is very important. This is now up to a new record, by the way. So that's interesting in itself in terms of asking prices. And you can see that brings us now to annual price growth of about 1.5%. Again, in asking prices, I stress that. Let's have a look at the other indices. So here was Halifax. They weighed in with a small reduction in the month. So don't forget that it's this balancing, isn't it, of the various indices. So you've got Rightmove at asking price. These are at mortgage. These are loaned money. So these are mortgage approvals, and you can see that in the month it's about minus 0.3, sorry. And that brings us to a quarterly change of about 1.3%, still in positive, and an annual change just on the line at 0.1%. So just absolutely dead flat. The Zoopla index is a blend. So it's a blend of mortgage approvals, of sold prices, and of asking prices. It's a good algorithm, that, to give you a real flavour of how the market's moving, and a very up-to-date picture too. And you can see that for Zoopla, in their latest index, they've got house price inflation in the UK at 3%. And you can see that the first-time buyer share of sales in 2022, bear in mind Help to Buy was still there, was over a third. In fact, Zoopla published in this month's report a breakdown of all of the sales in the UK last year, and the first-time buyer was the biggest share of the market. So it's too early to say how the end of Help to Buy is going to see that outturn. Don't forget, Help to Buy was only on new build. Now bear in mind that new build is only 10% of the market. So if you are taking that away from new build, and over 40% of first-time buyer purchases on new build were with Help to Buy, but even if all of those purchasers didn't buy, you're still only talking about half of 10% of the total market. So we shouldn't overstress that effect on the overall market. And as we've seen from Skipton and others, Deposit Unlock and so on, new products are coming in to fill that vacuum too. The Zoopla Cities Index still doesn't have Exeter in there, despite my asking Richard live on MarketCast last month, still no Exeter in there. But as you can see, there is still this huge national variation in their city index, with Nottingham at the top at plus 5%, 5.2%, and poor old Aberdeen still down there in negative growth at minus 2.2%. So the gap in markets in the UK, so in different markets in the UK, is still over 7%. I'm doing a lot of work at the moment on local markets and how they're moving against the background of the way the market is moving nationally and national sentiment, and the variations are huge, absolutely huge. So with Zoopla, one of their best pieces of data that they put into their report is the comparison this year against last year. 2022 was a crazy year, but more importantly for me, the comparison between this year and 2019, the last year pre-COVID, the last of what I would call the old normal. And you can see in terms of stock, well, we're well up on the position that we were against this time last year. Well, you saw that in the property mark numbers, but we're still 14% down on where we were in 2019. So that is why that supply and demand issue is still there in my matrix. And you can see flow of new supply, better than last year, but not as good as 2019. Number of sales agreed, look at that. So 14% down on 2022, no surprise. But 6% up on 2019, we're still above that number. And in terms of demand, well, 42% down on last year. Again, no surprise there, but 14% up on 2019, the old normal. I also pulled a couple of slides out of the RICS survey this year. Now, we all know that the members, the surveyors, the members of the RICS are noted for their pessimism. And so this really comes as no surprise. But the reason I thought they were important, and you'll see I call these two particular charts in here the canary slides, because they're really good at giving us a bit of future gazing. So over in here are the newly agreed sales for the previous month. So that's March, by the way, because this is the April survey. So this represents March. These are all the regions in the UK, including Scotland and Northern Ireland. This is England and Wales here. And you can see that they all had so this works a little bit like the consumer confidence one. So where a majority of their members says negative, it's a minus below the line. And when they say positive, it's above the line, a rare thing. But so you can see that generally, they saw the market as slowing down, and you can see that they all said that in March it was a slower month. And then if you look at new vendor instructions, really important, obviously, in terms of property supply and an indicator of people that intend to come into the property market, because vendors turn into buyers in the vast majority of cases. And you can see through here that you've got an even picture in terms of some agents are saying that there were more new vendors in the market and some saying less. But for me, that's suggesting a market that is calming down. And that's reflected in every piece of data that I'm looking at right now. And in terms of prices, so these are price expectations. How interesting is this? So, and these are the surveyors, don't forget. So these are the most famous pessimists of all. And over here, the aqua line, the broken line, is where they feel prices are going to go over the next 12 months, up or down. And look how that has made an incredible resurgence and has almost come to a 50-50 split between the agents about those who feel that prices are going to improve and those that are going to come down. An awful long way away from where we were at the back end of 2022, when they all thought we were going to go to hell in a handcart, along with the commentators in the press and, you know, dear old Moving Home with Charlie, who I follow on Twitter when I really want to depress myself. We can see it is so evident that people got that market wrong at the back end of last year. And I think those that are actually dodging that are really just fooling themselves. The data is absolutely incontrovertible in my view. And in terms of regional price expectations over the next 3 months, pretty solid and conclusive that the agents see prices are going to fall in the summer. And I agree with them as well. Don't forget, that is not an indication of how far or how fast they're going to fall. It's just that it's a significant majority, with the exception of Northern Ireland, by the way, but a significant majority of the agents in this survey. And don't forget, it's a fairly small sample, it's a few hundred when there are over 20,000 agents in the UK. But you can see that the vast majority expect prices to come down through the summer, and I agree. So very quickly then, as we run into the last couple of minutes, from all of that data that I've put out there for you, that we've collected and had a look at, what does 2023 have in store? This is the matrix on which I'm basing that call, which I took you through earlier on, and here's where I believe it's going to go. And one of the things that really irks me is when people talk about the property market and peak to trough and all the rest of it, but they don't actually say which measure that they're relying on, which I find, because you can find, even just in the indices that I've shown you here, we've got a variation of over 6%. So I'm going with a nationwide, because it's solid, it's consistent. It might not be the best algorithm. It is a little bit looking into the past, but it is consistently inconsistent. Solid blue blocks there are actual numbers. So you can see that we had a little bit of an uptick, unbelievably, in April. Not for us on MarketCast though, because we were all expecting it. We did predict that uptick would happen. And you can see that it came back to just above minus 3%, from below minus 3% in the March. I've got it coming up again in May. So I'm saying that there's going to be another uptick in the May numbers. Well, we'll see at the end of this month, won't we? The last time I made that prediction, I had a flood of emails after this went out telling me I'd lost my marbles, and we were proven right then. I think we're going to see, it will stay in negative, but we're going to see one more uptick in those May numbers. And then I think those RICS surveyors are right. I think we're going to see prices then ease through the summer. I think we will see price reductions as we come down into the summer, but I still believe then we will see an improvement, a little bit of a second pulse as we come into the autumn selling period. So that's how I see it. I see us ending the year at minus 4%. And this line here, which is measured against the right-hand scale, where you can see at the moment it's sitting at around 260 average price. I think that's going to go up and over 263k for the nationwide average price, but it's going to end the year around 252,000 for average price, about 4% down on this time last year. And in terms of volumes, I am still convinced we saw, this is the comeback in volumes, by the way, that we firmly predicted would happen once that hiatus of the last quarter of last year comes out. And the March numbers have shown a real comeback from the non-seasonal numbers. I still believe that we're going to end up with volumes in the UK for 2023 over 1 million. I am absolutely convinced of that. So sorry, I run a minute or two over. So we have had this spring pulse. We've seen it, we've experienced it. Hopefully those of you that are professionally selling out there, you've taken advantage of that. We're going to see that ease now. I think that RICS chart is a really important one. We will see that ease as we move into summer. And I expect that we will see that reflected in asking prices too. I expect to see that right move index come down, not strong into negative, but it's going to come down off the top, possibly be short minuses as we come into the next couple of months. Virtually everybody agrees out there now, certainly serious commentators agree out there now, that the prospect of a crash is tiny, certainly in this cycle. It would take something really significant to happen to see that crash happen. So I'm saying that we'll end up at about minus 4% with volumes between 1 and 1.5 million. 1 and 1.1 million, sorry, with new home share sitting at around at 12.5%. So there it is. That's the frantic rush back to 30 minutes through the MarketCast. Hope you enjoyed that. We've got a difficult summer selling season ahead of us. It's going to be tricky. I think you need to be commercial. I think you need to be prepared to take a little bit of a haircut. Currently, I think the average number according to Zoopla is about 4% off of asking price. And I think that's going to be reflected through the summer, maybe a little bit more than that. But then with a little bit of a resurgence in September. And we can discuss that the next time we meet. So I shall look forward to seeing you next month, and we'll update these numbers and update that forecast. Thank you very much indeed for joining me, to Joan and to James, who came off his sickbed this morning to get this production out. And I'll see you next time.